Why would Powell wrong foot the market over the next couple of days?
Well, I think that what we're going to hear from the Fed is the term well-positioned, which is, I think, something which they've used in a couple of the press conferences before. And I think that Powell's going to lean on that when he sort of communicates to us at the end of the week. And I don't think we're going to get a lot in terms of really whether they're thinking about 50 or 25. That's ultimately going to be settled by the labor market data that we get on September the 6th. Now, I think the important thing to remember when we think about the policymaking cycle for the Fed here is what the starting point of rates is at. And that the first 200 basis points of the rate cutting cycle is really about taking conditions from tight to something which is more neutral. And that can, in fact, play out quite fast. Now, whilst the data case may not be there for them to go 50 at the September meeting, and certainly our broad read of the labor market data is that it's softening, but it's certainly not falling off a cliff. You're not seeing the breadth of indicators that you might see if it was falling off a cliff. Jobless claims are reasonably well behaved. We'll get another update on that. Today, companies are not really talking about layoffs in any major way compared to what we've seen in recent quarters, but we are seeing this softening. And given that high starting point of rates, it makes sense to have that early part of the rate cycle play out reasonably quickly. So we certainly wouldn't be surprised in the context of the next several meetings if a 50 basis point or a couple of 50 basis points goes up. And we think that that's a backdrop where the curve can continue to be under steepening pressure.
So you, in this cycle, you are penciling in, what, a couple of 100 basis points cut? Pretty much a normal cycle of cuts then?
Well, I think that the question is, the 200 basis points of the cuts really speaks to just taking away these tight level of rates. Yep. I think that's what sets up a much more interesting setup for the bond market than we've been in for some period of time, because I think we are moving to this phase where growth dynamics rather than inflation dynamics are going to set things up. The central banks will no longer need to be as tight. Of course, the Fed is only embarking on this process of reducing rates most likely in the coming month. 6 other central banks and DM have already begun this process. We've clearly moved central banking into a different phase. That's a phase where bonds have different portfolio roles versus the phase where central banks are trying to fight inflation. And I think that, again, opens up scenarios where, there's a lot that's uncertain about 2025. The global growth picture is quite uncertain. There's certainly continued weakness coming out of China. There's lots of geopolitical uncertainty around. And I think there's in a scenario where you were to see more weakness than we would expect, you could see quite a drop in terms of front-end rates. So yes, our base case on a resilient scenario is something in the region of 200 basis points of cuts. But the skew is something which is more to the downside of that. And of course, the bond market, I think, allows you to get some protection to that in your portfolios now.
And I think this is the narrative that we've seen in this recent hubris, if I can call it that, or disruption at the beginning of August with the carry trade unwinding, is that bonds did perform very much as a hedge, or they have done in recent volatile periods, which then brings us to the shape of the curve. If we go with the thesis, as you say, look, man, it's probably 25, maybe some shotguns of 50-50, but overall 200. What do you see then the curve disinverting? Do you see a momentum? We saw a moment of disinversion, Simon, just a few weeks ago. Do we retest that, or how do I play the curve?
Yeah, I think we do see it go down the path of disinversion, and in a way which doesn't necessarily signal that we're going to go all the way to a very steep curve. But I think it's important to recognize that the policy cycle is likely to play out quite differently from the last couple of cycles. That with policy rates starting at this relatively elevated level, the Fed has a lot of policy space to adjust things with the short rate. And that particularly against the broader inflation environment that we find ourselves in today relative to where we were pre-COVID, it's not so obvious that the long end forwards in the curve needs to respond to any policy easing in the way that they would have done, let's say, for instance, in the mid-2010s, when we were operating against the effective lower bound. And then on top of that, you have this persistent high bond supply coming from all of governments really across the G10, which again is something which can keep the long end of the curve reasonably elevated. So it's our view that we are on the cusp of a sort of at least an initial steepening, which will be larger if we do have weakness inactivity, but that ultimately the next cycle will bring much steeper curves than we've seen in the last couple of cycles.